Hello traders and happy Monday. Okay, so last Friday we got the all-important non-farm payrolls employment data out of the US, which is the most closely watched economic data now, globally. And what we were expecting last Friday was for the headline number come out around about say 75,000 new jobs added, and the unemployment rate to go from 4.2 to 4.3%. The actual number came out weaker than expected. So the headline number came out at plus 22, so a good 50,000 lower than expected. And the unemployment rate did go up to 4.3%. So look, the key takeaway from this is that we do have confirmation now that the labour market is starting to weaken, it's starting to roll over. Now that we've got two disappointing labour market reports in a row. So what does it mean for Fed policy? Okay, so the September rate, FOMC, which is on the 17th, about a week's time, if that was not a slam dunk for a 25 basis point cut, certainly after the data, that is a slam dunk. So. But not only is market getting excited and confident about the Fed starting its easing cycle again, they're starting to price in quite a few more rate cuts. So in October, the median there, market's now pricing an 80% probability that the Fed's going to go back to back with 225 basis point cuts. But if we look out further out over the course of a year from now, market's actually pricing in 160 basis points of cuts. So that basically means that market at some stage next year, is expecting the Fed funds rate, the neutral rate where they stop the easing cycle, to be below 3%. So looks like the rate cuts are finally coming. Now, market-wise on Friday, what we saw. If we have a look at the bond market first, US 2-year yields and 10-year yields, they were off about 10 basis points, so more each. So 2-year yields settled down around about 3.5%, so it's multi-year lows. 10-year yields, they fell down to almost below 4.1%, settled around about 4.07, so almost taking out that 4%. So yields are finally cracking and are trending lower. Look, the US dollar, which obviously closely follows those yields, post the data, we did see some aggressive selling of the US dollar immediately. The US dollar did come back bid a little bit before the end of the session, so it did not close anywhere near on the lows for the day. But look, if we look further out, if what's happening with US bond yields continue to trade lower, and obviously with the Fed starting its easing cycle again, you can imagine that this is bearish for the US dollar, and no doubt the bias at the moment is to basically sell dollars on any sort of rallies, and bias is to stay short. But just on the currency market, over the weekend, we did see the Japanese Prime Minister resign. So dollar yen, which was obviously trading lower on the back of the payrolls report, gapped a lot higher. So yen weaker, back above 148. So it's been a real struggle to get dollar yen lower. But having said that, with what we've just discussed, the Fed starting its easing cycle again, I can't see dollar yen being a 150 plus sort of currency. So, going back up towards those sort of levels, certainly looks like we're back into the sell zone. Okay, if we look at precious metals, especially gold, absolutely loved that payrolls weaker report. Saw that spike up to print new record high at 3,600. It's opened here in Asia, just below those record levels now, around about 3,590. Gold has been on an absolute tear, trending exceptionally well, obviously, and buyers are in a mood, and also a lot of blue chip central bank names behind, this gold trending higher. So certainly would not be fading this anytime soon. As far as silver is concerned, that traded up to 41.50 on Friday. That was the previous high it set recently. Those 14 sort of year highs. But settled back below $41. So imagine, look, that's the level top side that silver bulls need to take out. Takes out 41.50. No doubt we're going to spike up again. But yes, buying silver on dips is also a favourite strategy. As far as equity markets are concerned, S&P, NASDAQ, yes, they rallied post the data immediately. Equity markets love rate cuts. But later on in the session, they did reverse those gains. The fact is that potentially the weaker labour market is sort of a red flag, recessionary, etc. But having said that, I mean, we're at record highs. A little bit of a retracement really is meaningless. So the equity market still looks pretty positive and printing record highs. I mean, that is bullish, obviously, on Friday. This week, the most important economic data that we have is going to be US inflation data on Thursday. So that's CPI data monthly for August. Last month, we did get core year on year, go back up to 3.1%. This is actually one of the things that a market that is pricing in rate cuts does not need a spike in CPI. So it needs to behave itself on Thursday, otherwise we're going to get a very confused market, and no doubt we're going to get some some volatility on the back of that, and I would say not positive volatility, it would be bearish. So Thursday, nothing matters until Thursday, this CPI number, that's for sure. Good luck beginning of the week with your trades, and we'll catch back in with you shortly.